Here's a question that should scare you more than any crash ever could. What if the market isn't broken right now? But that's exactly the problem. What if the fact that everything feels calm, confident, and endlessly profitable is itself the warning sign? Bubbles don't announce themselves with sirens. They don't send you a memo. They build quietly, one reasonable sounding decision at a time, until one day the floor isn't there anymore. And according to one of the most respected voices in all of investing, we may be living through exactly that kind of quiet buildup right now. The man raising the alarm is Howard Marks, co-founder of Oaktree Capital Management, a firm that oversees hundreds of billions of dollars and has built its entire reputation on understanding risk before everyone else does. Marks isn't a hype merchant. He's not selling a doomsday newsletter or trying to get you to panic sell your portfolio. For decades, through memos that Warren Buffett himself has said he drops everything to read, Marks has built a career on a simple, almost boring-sounding idea. The biggest danger in investing isn't losing money in a downturn. It's forgetting that downturns exist in the first place. And that forgetting, he argues, tends to happen at the exact moment things are going the best. So let's talk about why that happens, starting with one of the strangest and most memorable metaphors in modern investing, the cockroach. If you've ever spotted a single cockroach in a kitchen, you already know the unsettling truth that follows. You never just have one. Where there's one, there are dozens more hiding behind the walls, under the floorboards, in places you haven't thought to look yet. Marx uses this image deliberately because it captures something true about bad debt and bad lending. When you find one troubled loan, one company that clearly should never have been approved for that much credit, it's rarely an isolated mistake. It's usually the first visible sign of a much bigger problem that's been quietly multiplying out of sight. Here's the uncomfortable truth about how that infestation begins. The worst loans in any economic cycle are almost never made during a recession. They're made during the good times, when everyone is optimistic, when defaults are low, when every deal seems to work out, and when lenders start believing that maybe, just maybe, the old rules of caution don't apply anymore. Skepticism starts to feel like pessimism. Due diligence starts to feel like a waste of time. Why grill a borrower over their ability to repay when the last 20 borrowers all paid back just fine? Slowly, standards erode. Loan terms loosen. Lenders start competing with each other not on safety, but on how fast and how easily they can hand out money. Because in a booming market, the fear of missing a good deal starts to outweigh the fear of a bad one. This is how you end up with what are now widely called zombie companies. These are businesses that aren't earning enough profit to even cover the interest payments on their own debt, let alone pay it down. In a world of near zero interest rates, that kind of company could shuffle along indefinitely, refinancing cheap debt with more cheap debt. Kept alive not by sound fundamentals, but by the sheer easiness of money. Nobody had to notice they were technically insolvent because the bill never really came due. But interest rates don't stay low forever. And when borrowing costs rise, the math that was quietly propping these companies up stops working. Suddenly, the interest payments that were manageable become crushing. The refinancing that used to be automatic becomes a real negotiation or doesn't happen at all. That's when the cockroaches start crawling out from behind the walls, and investors who assumed the good times were simply the new normal find out the hard way that risk didn't disappear. It just went quiet for a while. Now, loans and zombie companies are one layer of this story, but there's a second layer that touches almost everyone reading this, even if you've never personally analyzed a corporate balance sheet in your life. It's about the S&P 500 itself, the index that so many people treat as the safest, most diversified bet in the world. The pitch has always been simple. Buy the S&P 500, own a slice of 500 of America's biggest companies, and you're automatically spread across the whole economy. Retailers, banks, energy companies, healthcare, industrials, technology, all working together so that no single company's stumble can take you down with it. Except that pitch is quietly becoming less true than it used to be. Right now, a tiny handful of massive technology companies, often nicknamed the Magnificent Seven, have grown so large that they account for roughly $1 out of every $3 invested in the entire index. Let that sink in for a second. When you buy an S&P 500 index fund today, you are not spreading your money evenly across 500 businesses. You are placing an enormous, concentrated bet on the continued success of a small cluster of tech giants wrapped inside a product that still markets itself as broad and diversified. That mismatch between perception and reality is exactly the kind of thing that tends to go unnoticed during a bull market and gets painfully obvious during a downturn. To be fair, this concentration isn't necessarily irrational. These companies didn't get massive by accident. They dominate cloud computing, artificial intelligence, digital advertising, and consumer technology in ways that generate real, substantial profits, not just hype. Marx himself doesn't argue that these 7 companies are wildly overpriced. Given their growth, their market dominance, and their profitability, their valuations can reasonably be defended. The real concern isn't really about them at all. It's about everyone else. Strip those 7 giants out of the S&P 500, and you're left with the other 493 companies, the ones that make up the true broad economy that index investors think they're buying. And by historical standards, those remaining companies are trading at price to earnings ratios that look expensive, sometimes uncomfortably so. Price to earnings ratio, if you're not familiar with it, is essentially a way of asking how much investors are willing to pay today for each dollar of a company's actual profit. When that number climbs well above its historical average across hundreds of companies at once, it tells you something important. Investors have collectively decided to pay a premium to accept less of a cushion in exchange for continued participation in the good times. That premium is what investors call the margin of safety. And right now, across large portions of the market, that margin has been quietly shrinking. This is really the heart of Marx's warning, and it connects directly back to the cockroach story. A shrinking margin of safety isn't dangerous because a crash is guaranteed to happen tomorrow. It's dangerous because it removes your cushion for when something unexpected inevitably does happen. Markets don't need a specific catastrophe to hurt investors who've stopped pricing in risk. They just need reality to fall short of the extremely optimistic expectations that got baked into valuations during the good years. And optimism, left unchecked for long enough, has a way of quietly turning caution into an afterthought, both in the lending world and in the stock market. Long stretches of prosperity have a psychological effect on nearly everyone involved, whether they're a bank loan officer or an everyday retail investor buying an index fund through their retirement account. The longer things go well, the more people start to assume that the good conditions themselves are the baseline, rather than a temporary phase in a cycle that has always eventually turned. So, what does Marx actually suggest doing with all of this? Notably, his advice isn't to panic, isn't to sell everything, and isn't to declare that a crash is imminent, because nobody, not even a legendary investor with decades of experience, can reliably predict the exact timing of when a market turns. His advice is quieter and, frankly, more useful than any dramatic prediction could be. Stay skeptical. Don't let a long run of good performance convince you that risk has permanently disappeared from the system, because risk doesn't vanish just because it's been dormant. It simply waits. Treat the calm not as proof that everything is fine, but as a reminder to look a little more carefully at what's propping the calm up in the first place. The second piece of his advice is about where your money actually sits. If a small number of US tech giants now make up such a disproportionate share of the market, and if the broader market around them is trading at historically elevated prices, it may be worth asking whether true diversification means looking further afield. Markets outside the United States and smaller companies that haven't been swept up in the same wave of enthusiasm often carry more reasonable valuations simply because they haven't been the center of everyone's attention. That doesn't automatically make them better investments, but it does mean the froth, the excess optimism that eats away at your margin of safety tends to be less concentrated there. None of this is really a prediction of doom. It's closer to a reminder of how cycles work. One that's easy to forget precisely when you least expect to need it. Every long bull market eventually convinces a new generation of investors that this time really is different, that the fundamentals have changed permanently. That caution is for people who don't understand the new economy. And every single time in history, without exception, that assumption has eventually been tested. The lesson from cockroach loans, from zombie companies, from an index quietly propped up by a handful of giants, isn't that collapse is inevitable tomorrow. It's that comfort itself is the thing worth questioning, because the moment nobody's checking behind the walls anymore is usually the exact moment the walls are already full. So the next time your portfolio statement comes in looking great and everything about the market feels smooth, easy, and endlessly rewarding, that's not necessarily the moment to relax. It might just be the moment to look a little closer, ask a few harder questions about what's actually holding those numbers up. And remember that in investing, as in old buildings, it's rarely the cockroach. You can see that does the real damage. It's the ones you haven't found yet.